Welcome to Stage 2 of Financial Literacy Mastery. In this part of our web series, we move beyond the basics and dive into the intermediate foundations of wealth building. You'll discover how money grows, the essentials of stock markets, mutual funds, bonds, and the tax basics every smart investor needs. We'll also help you build a strong financial foundation for your future. Whether you're just starting to invest or looking to sharpen your skills, this stage is packed with practical examples and key takeaways. Let's set the stage for your journey from saving to investing and learn how to make your money work harder for you. Many people confuse saving with investing, but they serve very different purposes in your financial life. Saving is about preserving money for short-term goals and emergencies, using tools like savings accounts and fixed deposits. Investing, on the other hand, is about growing your money for long-term wealth, using stocks, mutual funds, and bonds. Risk and returns are also different. Savings offer low risk and modest returns, while investing can bring higher returns but with varying risks. Both are important, but knowing when to save and when to invest is crucial for building lasting wealth. Let's explore how each fits into your financial plan. Inflation is the silent force that erodes your money's value over time. As prices rise, the same amount of money buys less than before. This is called purchasing power. For example, a cup of chai that cost rupee 3 in 2005 now costs rupee 15 in 2025. If you kept rupee 3 in your wallet all these years, you'd no longer afford that chai. India's average inflation rate is around 5–7% annually, which means your money must grow at least as fast as inflation to maintain its value. Understanding inflation helps you realize why simply saving isn't enough. You need investments that outpace inflation. You invest, it's important to look beyond the nominal return, the stated interest or growth rate. What really matters is the real return, which is what you earn after accounting for inflation. For example, a savings account offering 3.5% in a 6% inflation environment actually shrinks your wealth in real terms. Fixed deposits may barely keep up, while equity investments historically deliver much higher real returns. Always evaluate your investments based on real return, not just the headline numbers. This approach ensures your money truly grows and maintains its purchasing power over time. The Rule of 72 is a simple formula to estimate how long it takes for your money to double at a given rate of return. Just divide 72 by your annual return rate. For example, at 12% returns, your money doubles every 6 years. This rule helps you quickly compare different investment options and understand the power of compounding. Starting with 1 lakh, at 12% annual returns, you'll see your money grow to 2 lakh in 6 years, 4 lakh in 12 years, and rupee 8 lakh in 18 years, all without additional investment. Compounding is a powerful force for wealth creation. Banks are the backbone of the financial system. They borrow money from depositors at low rates and lend it to borrowers at higher rates. The difference, known as net interest margin, is the bank's profit. Banks also earn fees from loans, credit cards, and investment products. The Reserve Bank of India regulates banks, setting rules for reserves and lending rates. Understanding how banks operate helps you make smarter decisions about where to save, borrow, and invest. Banks play a crucial role in the flow of money and the stability of the economy. Interest can be simple or compound. Simple interest is calculated only on the original principal, while compound interest is calculated on the principal plus accumulated interest. Over time, compound interest grows your money much faster. For example, 1 lakh at 10% for 5 years earns rupee 50,000 with simple interest, but rupee 61,051 with compound interest. Difference may seem small over a few years, but over decades, compounding becomes extraordinary. Understanding this distinction is key to making smart investment choices and maximizing your wealth. Compounding is often called the eighth wonder of the world. The real magic lies in starting early and letting time work for you. Consider 2 investors. Priya starts investing at age 25 with 5,000 per month, while Rahul starts at 35 with 10,000 per month. Despite investing less overall, Priya ends up with a much larger corpus at age 60 simply because she started earlier. Time is the most powerful ingredient in wealth creation. The earlier you begin, the less you need to invest to reach your goals. Your credit score is a 3-digit number that represents your creditworthiness. Scores range from 300 to 900, with higher scores indicating better reliability. A score above 750 is considered excellent and gives you access to the best interest rates and easy loan approvals. Factors affecting your score include payment history, credit utilization, account age, types of credit, and recent inquiries. Maintaining a healthy credit score is essential for borrowing on favorable terms and avoiding costly credit. Credit utilization is the percentage of your total credit limit you're currently using. Keeping it below 30% is recommended for a healthy score. Credit card debt is one of the most dangerous traps, with interest rates as high as 36–42% per year. Carrying a balance can quickly destroy wealth, as the interest compounds rapidly. Always pay your credit card dues in full before the due date and never treat a credit card as a loan. Avoiding high-interest debt is crucial for financial stability. Stock market can seem intimidating, but at its core, it's a marketplace where ownership of businesses is bought and sold. Shares represent proportional ownership in a company. As a shareholder, you benefit when the company grows and may receive dividends. Understanding this basic idea makes the stock market less mysterious and more accessible. Investing in stocks is a way to participate in the growth of businesses and the economy. Initial public offering, IPO, is how companies raise money from the public for the first time. Before an IPO, a company is private. During the IPO, shares are offered to the public in exchange for capital. The process involves filing a prospectus, regulatory approval, setting a price band, subscription, allotment, and listing on stock exchanges. Once listed, shares trade in the open market, and their price is determined by supply and demand. India has two primary stock exchanges, the Bombay Stock Exchange (BSE) and the National Stock Exchange (NSE). BSE is the oldest in Asia, while NSE is dominant for derivatives and retail trades. Both operate Monday to Friday and are regulated by SEBI to protect investor interests. Indices like Sensex and Nifty 50 track the performance of top companies and act as barometers for the overall market. Market indices like Nifty 50 and Sensex are baskets of selected stocks that reflect the overall market's health. Nifty 50 tracks the largest companies on NSE, while Sensex tracks the most liquid companies on BSE. Indices are reviewed periodically, with underperforming companies replaced by stronger ones. When the index rises, it signals economic growth and corporate earnings expansion. Stock prices change constantly, driven by company performance, macroeconomic factors, global cues, and investor sentiment. Markets are not always rational in the short term, and prices can swing above or below intrinsic value. Over the long term, stock prices tend to reflect the actual value of the underlying business. Understanding why markets fluctuate helps you stay calm during volatility and make smarter investment decisions. Fundamental analysis is the study of a company's financial health and business quality. Key metrics include price-earnings ratio, return on equity, debt equity, and earnings per share growth. These help you determine whether a stock is worth buying at its current price. Fundamental analysis is essential for long-term investors who want to invest in quality businesses and avoid speculation. Technical analysis focuses on price and volume data to forecast future price movements. It uses concepts like support, resistance, moving averages, and the relative strength index, RSI. Unlike fundamental analysis, it doesn't evaluate the business itself, just the market's behavior. For long-term investors, fundamentals matter more, but technicals can help with timing your entry and exit. Markets move in cycles, bull markets with rising prices and bear markets with falling prices. Investor psychology plays a big role in these cycles, often leading to costly mistakes. Many investors buy at the peak and sell during downturns, driven by fear and greed. Disciplined investors do the opposite. They buy quality businesses during downturns and stay invested through volatility. Understanding market cycles helps you avoid emotional decisions and build wealth over time. Mutual funds are professionally managed investment vehicles that pool money from many investors and invest across a diversified portfolio of stocks, bonds, or both. Each investor owns units proportional to their investment. Fund managers select investments, and returns are shared among all investors. Mutual funds are regulated by SEBI and offer a convenient way to diversify without needing expertise or large capital. AV, or net asset value, is the per unit price of a mutual fund. It's calculated daily after market close by dividing the total value of the fund's assets minus liabilities by the number of units outstanding. When you invest, you receive units based on the NAV. A higher NAV simply reflects historical growth, not a more expensive fund. Understanding NAV helps you track your investment's performance. Mutual funds come in various types, each with different risk and return profiles. Large-cap funds invest in top companies and offer stable growth. Mid-cap funds target medium-sized companies with higher growth potential. Small-cap funds are riskier but offer the highest long-term growth. Index funds mirror market indices, while hybrid funds mix equity and debt for balanced risk. Debt funds invest in government securities and corporate bonds for stable returns. Systematic Investment Plan (SIP) lets you invest a fixed amount in a mutual fund at regular intervals, usually monthly. SIPs remove the need to time the market and build investment discipline. You can start with as little as $500 per month. By investing consistently, you benefit from rupee cost averaging and reduce the impact of market volatility. SIPs are a great way to grow wealth over time. Rupee cost averaging is the principle behind SIPs. By investing the same amount every month, you automatically buy more units when prices are low and fewer units when prices are high. This reduces your average purchase cost over time and helps you benefit from market dips. It's a simple yet powerful way to protect your investments from volatility and maximize returns. Mutual funds are available in two variants, direct and regular. Direct plans let you invest directly via the AMC's website or app, with low expense ratios and no distributor commission. Regular plans involve a broker or distributor and have high expenses. Over the long term, direct plans generate higher returns due to lower costs. If you're comfortable doing your own research, choose direct plans for better wealth growth. Bonds and fixed income instruments offer stability, predictable returns, and capital preservation. A bond is essentially a loan given by an investor to a government or corporation, which pays periodic interest and returns the principal at maturity. Bonds are an essential part of a balanced portfolio, especially for those seeking lower risk and regular income. Understanding bonds means knowing key terms. Face value is the principal amount, coupon rate is the annual interest paid, maturity is when the principal is returned, yield is the actual return based on purchase price, and credit rating indicates default risk. AAA is the safest rating, while D means default. These terms help you evaluate bond investments and choose the right ones for your portfolio. Bond prices and interest rates move in opposite directions. When interest rates rise, existing bonds with lower coupons become less attractive and their prices fall. When rates fall, high coupon bonds become more valuable and their prices rise. Understanding this relationship is crucial for fixed income investing and managing portfolio risk. Fixed income investments in India include government bonds, PSU bonds, corporate bonds, and debt mutual funds. Government bonds carry the lowest default risk, while corporate bonds offer higher yields for more risk. Debt mutual funds provide easy access and professional management. Each type serves different needs, from capital preservation to income generation. Fixed income investments are ideal for preserving capital, generating income, reducing portfolio volatility, and short-term parking of funds. Retired investors often rely on bonds for regular cash flows, while others use them to cushion equity portfolio drawdowns during market crashes. Liquid funds and ultra-short debt funds can replace idle savings accounts for short-term goals. Taxes can significantly reduce your actual wealth, so understanding tax basics is essential. Capital gains arise when you sell an investment at a profit and are taxable under the Income Tax Act. The tax rate depends on how long you held the investment. Knowing the difference between short-term and long-term capital gains helps you plan your investments efficiently. Equity and equity mutual funds, short-term capital gains, STCG, are taxed at 20% if held for less than a year. Long-term capital gains, LTCG, are taxed at 12.5% above rupee 1.25 lakh if held for more than a year. Gains up to 1.25 lakh per year from listed equity are tax-free. Holding investments longer reduces your tax rate and increases your net returns. Taxes directly affect your real returns. Two investors earning the same returns can end up with different net amounts depending on their holding period and tax rate. For example, a short-term investor pays more tax and retains less, while a long-term investor benefits from tax exemptions and lower rates. Tax-efficient investing improves your actual wealth compounded over decades. Section 80C of the Income Tax Act allows you to claim a deduction of up to 1.5 lakhs per year by investing in approved instruments like ELSS mutual funds, PPF, EPF, and NSC. ELSS is popular for its short lock-in period and equity-like returns. Using 80C provisions helps you optimize taxes and increase your net wealth. For investing aggressively, you need a solid financial foundation. Like a building needs a strong base, your investment journey requires structure to withstand shocks. This includes an emergency fund, insurance, and goal-based investing. Building your financial pyramid step by step ensures stability and long-term success. Emergency fund is your financial safety net for unexpected events like job loss, medical emergencies, or major repairs. You should keep 3-6 months of expenses in a high-yield savings account or liquid mutual funds. Don't invest this fund. It's meant for liquidity, not returns. Using it only for genuine emergencies protects your long-term investments from short-term crises. Insurance is about risk protection, not investment. Health insurance covers medical expenses, while term life insurance protects your dependents. Choose policies with adequate coverage and buy early for lower premiums. Avoid mixing insurance with investment. Term plans offer pure protection, and you should invest separately for growth. Every investment should match a specific goal and time horizon. Short-term goals require capital preservation, while long-term goals benefit from equity volatility. Use liquid funds for emergencies, hybrid funds for medium-term goals, and equity funds for long-term wealth creation. Matching investments to timelines reduces risk and improves outcomes. Build your financial foundation in this order. Step 1. Establish an emergency fund. Step 2. Get health and term insurance. Step 3. Clear high-interest debt. Step 4. Start SIPs for medium and long-term goals. Step 5. Optimize taxes using 80C and other provisions. This pyramid ensures you're protected and ready to invest for growth. Let's recap the core principles of investing. Investing beats saving in the long run. Compounding needs time. Markets fluctuate, but patience wins. Diversification reduces risk. Taxes impact real returns. Foundation comes before aggression. Discipline is more important than timing, and risk is manageable, not avoidable. These principles guide your journey to financial mastery. Completing stage 2, you can now explain the difference between saving and investing, calculate real returns, understand compounding, read stock fundamentals, grasp mutual fund basics, explain bond prices, identify capital gains, and build a personal finance structure. These skills set you up for smarter financial decisions and long-term wealth. Stage 3 will build on this foundation and take you deeper into portfolio construction, equity research, debt management, retirement planning, advanced tax strategies, and real assets like real estate and gold. You'll learn practical mechanics for managing investments and optimizing your wealth. Get ready for the next level of financial mastery. Financial knowledge is powerful, but action is what makes the difference. Before moving to stage 3, consider opening a mutual fund account and starting a SIP, even with a small amount. The best time to invest was yesterday. The second best time is today. Taking small steps now sets you up for long-term success. Stage 2 has taken you from basic money concepts to practical investing knowledge. You've learned about compounding, stock markets, mutual funds, bonds, taxes, and building a financial foundation. These lessons empower you to make smarter choices and grow your wealth. Remember, consistency and discipline are key to financial success. Congratulations on completing stage 2. You're now equipped with intermediate financial skills and ready to tackle advanced investing and portfolio management. Stay curious, keep learning, and continue your journey toward financial independence. The next stage will unlock even more strategies for building and protecting your wealth. You've reached the end of stage 2, financial literacy mastery. Review your notes, revisit key concepts, and prepare for the next stage. Remember, financial literacy is a lifelong journey. Each step you take brings you closer to your goals. Continue to stage 3 for advanced investing and portfolio management.